Last, liquidations. Very useful for confluence and divergences, simple and objective, but they have an element of trust. So, liquidations, not to be confused with liquidation map. Liquidations in this context is this. We actually go and look at the liquidations. A liquidation heat map is a guess about what might happen. Liquidations here are actual liquidations that have happened. They're in the past. And why they're useful is when you look at divergences. Right? So you might look at chart here and you'll see, where are we looking? You will see price going higher, but liquidations going lower. Right? So here we had really high liquidations. Price kept going higher. Liquidations kept going lower. And what happened? It led to a pullback. Now, a relatively small pullback, but a pullback nonetheless. And that's because as the market tried to go higher, one of the indications of a rising market will be short liquidations. And if short liquidations are decreasing, it's a sign that the positioning is becoming more neutral. Right? So from having too many shorts who get squeezed, we have fewer shorts getting squeezed, then fewer shorts getting squeezed, which would be an indication that the short squeeze element is slowing, and that could lead to a pullback back to somewhere where if it's bullish, like this, it might just pull back to where support is so that spot players or passive bid can come in. But all you need to look at is go and test it. If you're going to use liquidations, price higher, licks lower, price lower, licks lower, right? It goes in both ways, or a divergence sign. Right? Again, not every time, like you see here. Price went down, liquidations went up. That should be a continuation, right? Because no divergence there. Price down, lots of liquidations. Price down more liquidations. That should actually equal further downside. So like everything, it's not perfect. It doesn't work all the time. But when it does work, or when you would look at it and say, here we go, where it has effectiveness, price goes lower, liquidations go lower, divergence, price goes the other way, right? So I'm a fan of liquidations as a standalone. I actually like them because they're the least noisy. They're almost just like volume itself. It's either liquidations are either there or they're not, right? There's no arguing with it. It's quite easy then to keep yourself objective and disciplined and consistent. So that's great. But yeah, try those. Now, I mentioned here, element of trust. What does that mean? There's a problem with really all of this data, but especially liquidations. It's reliant on when the exchange broadcasts the liquidation data, which there is, over the years, I've definitely observed that different exchanges report liquidations in different ways. It's not as simple as the microsecond that a position gets liquidated, it gets immediately broadcast and is picked up by the API of Coinalyze and shown on the chart. Sometimes the liquidation data doesn't come through for seconds, minutes, hours, who knows. Sometimes it doesn't come through in the candle where the actual liquidations happened. It comes at a different candle, and sometimes you can see this. Maybe I'll be able to find it if I look at like, let's say we go to Bybit, because I think this happens more frequently on Bybit in my experience. Sometimes you'll see this. Maybe I can see one. Where you have these massive liquidations that appear. I mean, some of those are pretty solid. Some of these liquidations appear in areas where they really otherwise shouldn't or wouldn't. Yeah, like here. Here's a great example. This is obviously when the liquidations happened, right? Here. That's obviously when the liquidations happened, yet the majority, a higher bar of liquidations came a few candles later, which is an indication to me that some of this is being delayed, or either being delayed in broadcasting or how it's actually transmitted, or the exchanges themselves are running a liquidation engine that doesn't liquidate right away. That's important because when somebody's account goes into ADL, automatic deleveraging, that means the exchange takes over and they liquidate the account for you. It doesn't mean it gets liquidated right away. Your exchange goes to zero right away. Your balance, if you get liquidated, goes zero right away. But they have to actually go and process those sell orders. And we don't really know how they're doing it. Are they internalizing that flow, et cetera, et cetera, et cetera? And this is obviously more prevalent on low time frames. We'll see it. Here, even like this, to be honest, like even like this relatively huge liquidation spike that happens not below any lows and after the decline, doesn't seem to me like that is actually where the liquidations were occurring, especially in context of where the bigger moves were happening. So that's a small side note that generally doesn't matter massively, but there is an element of trust that you are getting the data from the exchange that's actually accurate. Now, does it really matter overall? Not so much, because we all deal with the same data. So if you're building and testing and using your systems, you're using them based on the same data that everybody else is. So you're not at a disadvantage to the average trader. So how much does it really matter? A bit, maybe not that much. Now, how to put this into a system? I'm going to give you a couple ideas. One of the best ways would be to combine open interest and delta. Right. So remember what I said before. Open interest doesn't tell you the full picture. Neither does delta. But combined, they can. So what you've got here is price obviously on top. You've got the delta of volume, and then you've got the open interest here. So price, delta, OI. Price comes down into a low. It fails to go lower. There is a large spike in delta, so there's high delta. Price is down. Open interest goes down significantly, and high delta. That means longs are wrecked. You can safely assume longs are wrecked there. Longs have gotten liquidated, stopped out, whatever. Because you have an overabundance of delta, high delta, so high market selling, with a corresponding decrease in open interest. So that means the market selling meant that people were closing. And it also means that people have closed on the other side, buying as well. But remember, that's also a benefit, because when price fails to go lower, price itself, that tells you that the demand, the passive side, was actually absorbing. So that's demand. I'll explain again, because I know this is confusing. If open interest goes down and there's high delta, that means that the market order side is very active, right? The market order side is showing that a lot of short positions, like sell orders, I should say, which is going to be longs closing, are being enacted against their will or with stop losses or willingly. It doesn't really matter. A lot of selling is happening, hence the negative delta. The open interest drops, which means both a long and a short are closing. We know that the long closing is getting stopped out here. But if there is a short closing and price is failing to go lower, that means they're buying at that level. So that's passive demand. Meaning, whoever's the limit order has chosen to buy at the support. And if you continue to watch price, you'll see the price fails to go lower because the selling was absorbed by the passive buying. And the combination of delta and open interest can tell you that that essentially was, if you want to put this into simple terms, longs got wrecked into the lows, it's likely to bounce. Because what we wanted to see has happened. Longs wrecked, high delta, open interest down, but price did not go lower. If price had went lower, way below that low, then cool, that could be a breakout. But this is actually not. It's potentially actually going to hold there. And then price comes back, another retest, and it goes higher. The way you combine that is with price itself. You take this, and then you wait for a price trigger. So you take your price action, you look for a market structure break on a lower time frame. You look for higher highs and higher lows to start forming, again on the lower time frame. You find an area where there is a sweep or whatever. You could use the 5 minute here, comes back above that level. That's price moving the other way. You go long. You go a 1 minute chart, that's a 5 minute. You go down the 1 minute chart, you could zoom in and look at it closer, which I will actually do now. So, because we still have this one. This one happened over here. And that's the liquidation of it. I actually want to keep that one there because that's the next part. Let's go over here and look at this. And we look at this 5 minute one. And we look at open interest. And so in Coinalyze, if you're looking for the delta itself, go to the buy sell volume. That's the indicator. And change it to delta. Take everything else off. Change it to histogram if you want to just see it visually. So you can see then. This is the part I was referencing over here on the screenshot. You can see the high negative delta. You can see the open interest decline. And you can see the price fails to go lower. So if you're looking at this, you go to a lower time frame. You would zoom it in, and after you've seen all that, you'll be looking for a price signal. So let's just take something really simple like a market structure break. You'll be looking there is none. Comes down, goes lower, so it goes below the low. Then it comes back above, there's a market structure break. So at that point, you could go long if you're testing that system. And so you might go long there, you might put your stop loss down there, saying that all of this I've seen shows passive demand into market order longs getting wrecked. We should go the other way. Maybe we target the liquidity above, there it goes, boom, right? So that's how you can use it in one sense. And another way, liquidations. So I showed this kind of a little bit already, but really simple. Liquidation divergence. Super high liquidations, price goes lower, much lower liquidations, that's a divergence. Get your price trigger, trade it. And of course, test all of this. You can see that here. Liquidations decrease significantly as price fails to go lower, market structure break, you enter there or you enter on the retest or whatever, same phase of price action, and away it goes. You'll notice that the open interest in delta and the liquidations all gave the same confirming signal at this exact period of price action, which indicated a strong possibility that price is going to go higher. Where does it go to? Again, that's not the topic of this lesson. You'd have to find areas to target. Maybe it's liquidity, maybe it's order blocks or gaps or whatever, or you wait until you see divergence in the other direction. That's all stuff for you to put into your own systems and test them. Yeah. And finally, include these in a system with price action as the main input, what I just showed. You can see all the data you want, but to actually enter, because when you see this, first of all, you don't know it's a divergence, so you can't enter. If you see that, and you're looking at it on the delta, you can see for sure this should be correlating with a bottom, but how can you enter there? You can't yet, because you don't have a price trigger. Because what could you do? You could enter there and put your stop loss at the lows. Well, it gets stopped out. If you wait for your price signal, which is following that, then you have your divergences or you're confirming OI and delta signals, and then you use price to get your entry, define your stop loss, and away you go. And that is it. G fucking M. All right, questions? GM. I'll go through some here. Hungry Hugo, GM. Based on your experience and knowledge, if you had to use data to add confidence to a reversal scalp day trade, how would you do it? Already covered that just now. Would you use it as higher time frame confidence? I like using 1 hour mostly for max high time confidence, or assuming you use the 1 and 5 minute entries, use the open interest and low time frames to filter out the noise during the day. I hope the question is understandable. Yeah. So lower is better. Lower time frames are better. Oh yeah, there is one thing I need to cover though. So I don't want it to seem like higher time frame stuff has no relevance. It actually, when you go to the extremes, so such as major highs like the last bull market, there was definitely an open interest signal in the last bull market, where on the second attempt to break out of all-time highs, the open interest was significantly lower. That is a major divergence. But on a day-by-day, week-by-week basis, the changes and differences in open interest are not going to give you confirming signals. They're going to very often be conflicting signals. And if you're actually looking to trade it in a repeatable fashion, lower time frame is more accurate and more reliable. So it's not like higher time frame, absolutely. Higher time frame stuff can be useful, but to actually use it in a system and trade it, lower times is better. Cope G, when you refer to the tape, is this the same as the tape frequently mentioned remnants of stock operator? With OI, I've heard you speak about market makers being responsible for filling the opposite side of the contract. Correct. There's a way to differentiate between traders filling each other's orders and market makers filling. The assumption coupled with experience. The assumption should always be that the market maker is on the other side of your trade. It's not always true, but the vast majority of the time, if you're going long at the market, if you're going in with a market order, it's important to note. If you're entering with a market order, the person on the other side of your trade is going to be a market maker, right? That's 90% of the time. If you're entering with a limit order, you're acting like the market maker. The person on the other side of your trade is not going to be a market maker. Market makers don't use market orders. They wouldn't have a profitable business if they did. So it's going to be someone else. It doesn't mean they're dumb. It could still be someone smart money using a market order, right? That's perfectly possible. But it's not going to be a liquidity provider. A liquidity provider, which is what a market maker is, they provide liquidity by putting it on the order books, not by smashing buy and sell market orders. And in terms of the tape is just the running number, the running total of orders. So the tape, as it's seen in Reminiscence of Stock Operator, is just the price quotes. So that's the price coming through. Like back in the day before they had computers, there would be, or the price quote would be coming in saying Bitcoin is 65,523. And then however often they update it, back in the day, way back when they would do it on chalkboards, they would update it every, whatever, I don't know, every few minutes, every few hours, every day, depending on whatever asset it was. So a tape is just time and sales. Time and sales is also how it's known. So the time and what the order was. So at, 6 p.m., 6:09 and 32 seconds, there was a 0.34 BTC buy order on Bybit. Time, sales, and it gets broadcast in a list. So that's the tape. Miu GM, Alex GM, Pulax GM, EMA cross R2R, not relevant. Ask me somewhere else, please, bro. It's not relevant to this lesson. Snipey Phoenix, us traders can use liquidation maps for our potential targets in high time frame view. After liquidation happens, where can we see the exact number? Is there any delay numbers update? I've already answered the delay part. That yes, there can be a delay. Depends on the exchange. Again, I don't run the exchanges. It's up to them. And they don't have to tell you when or how or what their method is. It's up to them. They do broadcast the liquidations. Do they do it immediately? Most of them, generally, most of the time, it's pretty immediate. But there can be delays. Can you use liquidation maps for your potential targets and high time frame view? I mean, if you want to. All it really shows is it puts a heat map above the areas that we would know anyway as traders. The heat map will always cluster the highest areas of liquidations at highs and lows on significant time frames. Daily highs and lows, weekly highs and lows, swing highs, swing lows, right? So you could use it. Fawizu, buy sell volume equals CVD cumulative volume delta. Yeah, actually I'll run through a few of the different ways you can set these up. That was the other thing I needed to do. So on Coinalyze, buy sell volume on Coinalyze. You also have CVD. You also have CVD aggregated, spot and futures, right? So these are all really essentially the same thing. The buy sell volume will just show you the data in a different way. So when you first open it up, it's got everything open. And you go if you click into it, go to the style. That shows you in each candle, that shows you the buy volume on that exchange. Remember, this is on Coinbase. So it shows you the buy volume and the sell volume. So that is, in this candle here, you have more selling than buying in terms of the market orders. And it shows you each of them individually. If you tick delta, it then puts on the delta bar, which subtracts one from the other to give you the net. Generally, I don't put all these on at once. It's just a mess. So what I do is I take off cumulative delta, because if you want that, you can use it on a separate part. I take off this as well, delta price change divergence. You can use that if you want. I don't find it to be particularly, again, more noise than signal. And so there's two ways of really looking at this. If you're looking at the buy sell volume, you can either have it as buy volume and sell volume, which can be very useful if you want to just look and see visually if there is dominance, particularly in one area or the other. Like here, for example, there's a pretty strange, massive dominance of buy orders than sell in a red candle that's kind of in the middle of nowhere. It's interesting, right? That's not the norm. That's not typically what you expect to see. So if you want to view them separately like that, you can do buy volume, sell volume. If you want to put them together as delta. I would change the histogram, so I prefer to view it with just the bars. And that is the exact same as buy volume, sell volume, except instead of showing you both, it aggregates them and you see the net, right? And the only difference between that and a cumulative volume delta is that the cumulative, that's the key word, it just tracks that across a period. right? A time period. Or you can define the period yourself. So when you see CVD, that's taking all of these. You'll notice that anytime there's a big green delta bar, the CVD also rises. That's because the cumulative is rising. If there is a series of negative delta, the CVD will fall. And that moves along, and it moves and moves and moves across. Basically, I think on Coinalize, it moves across whatever time frame you're viewing. So if you zoom out as far as you can zoom out, you'll see it from where it goes. A better way of using it, if you're looking to get a specific, if you're looking to identify specific parts or areas on the chart, you can click into this. So take that one out. I'll take that off because that you should know that by now. You can click into this and you can look at the bars. So you can choose to look at the CVD only for the last n bars, meaning number of bars. So if you're on a 5-minute chart and you want to see the last day, 24 hours. So you look at 24 hours and there's 12 5-minute bars in an hour. So there's 288 in a day. So if you type in 288, that will show you the CVD only from the last 24 hours. So now, from 24 hours ago to now, you can see the CVD in more detail. It's not showing you anything before that. So you can look at the divergences, you can look at the changes across it with that in mind. So that's CVD for an individual chart. It's aggregated. Again, the only difference in aggregated is it aggregates them. So you have spot, and you can see, click in and make sure you select them all if you want to see them all, or you can remove them if you want to look at just Binance or one of the individual exchanges or whatever. That's all the spot exchanges aggregated together. So that's like your total market view. And the exact same thing for futures, all the futures markets. And so you can look at them individually, or you can look at them as an aggregate. Depends on what you're trying to do in your specific system. The benefits of looking at the aggregate is if you're looking more at just a general market move, you can use the aggregate. If you look at individual exchanges, you might be able to see at an extreme, like let's say you saw this pump here. If you went and looked through Coinbase and Binance and Bybit, and then on the perps, you looked at OKX and Bybit and Binance. If you looked into all the individual ones within that, you might be able to see which exchange was having the most action. You might notice, and over time you might notice that all of this was happening on Binance, really. It was like a really aggressive short squeeze just on Binance. The rest of the markets are kind of quiet. And that over time might give you some indication of what tends to happen whenever there's Binance squeezes. This is like getting way into the weeds and like very advanced stuff. But that's it. Use it aggregated. So delta is the basic, volume delta. Cumulative volume delta is the exact same thing. It's just accumulated. It accumulates over a time frame. Aggregated is just when multiple exchanges are put together. And then spot and futures is the two different types. On Velo chart, exact same thing, right? Except it's named slightly differently. So on Velo chart, if you go to indicators, you want to look at volume. So just volume itself. So your standard volume bar. Then you go in and you go view delta. There. Now that is the exact same as what I just showed on the buy sell volume. So on Velo data, it's called volume, and you go in and you change it to delta. You then have aggregate volume, which is the exact same thing again, except it's across all those exchanges, right? Perpetual exchanges. You can change the delta. Then you have aggregated spot volume, which is over here, which then gives you a view of all the spot exchanges, and you can go delta. So now you can look at the current chart you're on, which is Binance Futures. You can look at the aggregated, all the futures markets, and the aggregated all the spot markets. So that's how delta works over there. What else? And that's what we're talking about there. And then same thing, but for open interest. All right, so open interest, fairly self-explanatory. You have aggregated open interest and you have open interest itself. So you click in, nothing happens there. You can view it as candles, change. I keep it as candles. You can view it as coins or dollars. Just be consistent with whichever one you use. And here, obviously, just has the different exchanges. Over on Coinalize, it's the same thing. Just looks slightly different. You have aggregated open interest, stablecoin plus coin margin contracts. So that's both of them. Or you can just break it into stablecoin or coin margined. Stablecoin and coin margin, they're just two different types, whether you use stablecoin as your collateral, like USDT, or you use Bitcoin itself. So if you click into these, you'll see, it'll show all the exchanges. They're always USDT, or the coin margin ones, it is USD coin margin on those exchanges. Or just use the aggregate. Sorry, that was the coin margins there, sorry. All right. And if you're looking just at the aggregate, do aggregate, open interest, stablecoin, and coin. That's all of those exchanges together as an overall view. If you want to just look at one exchange itself on Coinalyze, you go to the individual chart like BTC USD perp Binance. So perp obviously means it's perpetual futures. You can then go to open interest just itself, and that will show you just the open interest on that exchange if you want to look at just one exchange. Open interest, done. I think that's everything, isn't it? I think that is everything. Can the order books be used in spot and price reversals? KGLX, they're not reliable in my opinion. Percentage long and shorts, not reliable either. Question about Agar. Yeah, again, very, very, very hard to put it into an objective system. And Agar's totally separate to this lesson. So yeah, order books, they're not reliable because it only takes a fraction of a second to remove that order. So, again, if you want to dig into that and see, I can see someone spoofing, sure, but that's an entirely different approach, which I don't recommend. And percentage longs and shorts, I've never found that to be useful. More of a correlation than a causation is what I would say there. It's not predictive, it just follows, right? So you'll see the percentage of longs and shorts change as price rises, but is it the percentage changing that creates price to rise, or is price rising what creates the change, right? So you should get into the correlation versus causation. Daniel, GM, is my understanding of open interest right? Long opening buys, long closing sells equals OI flat. If a long opens and a long closes, so basically if there's a buy order, a new buy order, and a closing sell order, OI flat, yes. You need both for it to rise. Short opening, short closing, flat, yes. Long opening, short opening, up by 1, yes. Short closing, long closing, OI down by 1, yes. Correct. Perfect. GM. Yeah, you're correct, Michael. For many, it's too advanced. This is very advanced stuff. It is not something that you need to know right away. It is something that, again, ask my masterclass students, ask my captains, ask the purple belts. It's going to be something that you develop over time, right? It's not going to be something that you need to know right away. These guys have gone through years of learning, especially like my masterclass guys, and now they're starting to use it, or they've used it and it's working and it's coming together. It's not something that you have to think about it in terms of, I need to know this right away. It's very sexy and everyone wants to be able to look into the open interest changes and spot the divergence and catch the liquidations. This stuff is way down the line of what's important. Get the foundation first and you'll take it from there. All right. What indicator for buy volume, sell volume? Can't find it. I just covered all that. So hopefully you found it there. All right. GM. Why is questions closed? Because while I'm doing the lesson, I open the questions. Whenever the lesson's done, I close it because I'm already 20 minutes over time. So we got done. Good one. GM. Thanks for joining, everyone. GM. Well, actually, Nico. The problem with liquidations, I guess, if it's in harmony, expecting to go lower or higher could potentially signal a div because high lick could signal a potential bottom top. Exactly, yes. So much nuance. High volume, high liquidations, high changes, basically any extreme can also be a marker of a bottom, and you won't get a lower low to provide a divergence because sometimes, especially on your extreme moves, like we saw last month, we saw massive liquidations and that marked the bottom, right? So here you see enormous liquidations and you'd be like, that's harmony. It's going lower. It's going to go lower. And price did, but what this definitely tells you, price will try to go lower. So price did try to go lower. But it doesn't mean you have to, it has to go here and then there has to be a divergence before I could go long. It's not always going to do that. And quite often, because there was such a violent liquidation flush, All it needed was a retest. And away we go. Okay. GM. Loads of people have done some top G notes for this, guys. So thank them for it. You should have taken your own notes as well. This recording will be up for 24 hours. Then it'll be gone. Thanks for joining, everyone. GM. See you tomorrow for big crossover stream with Professor Ayush. Me and Ayush, Stocks Campus, Crypto Trading Campus, 6 p.m. UTC. Let's fucking go. GM.
With Professor Michael G. Trading game strong, schooling all the wannabes. No recordings, no replays, gotta be there live. Boot camp students, let's hustle and thrive. Dot charts and candlesticks, knowledge bomb in the air. Trading warriors in the room, we never fight fair. Professor Michael dropping gems, wisdom so rare. We just dedicated future millionaires declare. Trading warriors.